Palantir Technologies just delivered the single most aggressive quarter in its entire history. Yet, right now, we are looking at a massive institutional sell-off. The market is pricing in a violent shift, and the surface-level numbers absolutely do not match the reaction on Wall Street.
We have a severe market contradiction unfolding. Top-line revenue growth just hit a record 85% year-over-year, pulling in $1.63 billion. But look at the equity itself. The stock is down a crushing 42% from its peak last November. This is a massive structural divergence between operational performance and actual share price. This entire disconnect is mathematically anchored to one staggering metric, an 80 times trailing sales multiple. When a stock is priced with this kind of perfection, there is zero margin for error. A flawless earnings report doesn't add upside anymore. It merely prevents a total collapse. Section 1. The current market reality. The ultimate valuation compression. We are currently witnessing severe valuation compression. Institutional sellers are liquidating their positions based on overseas friction and regulatory headwinds, actively ignoring the reality of surging U.S. demand. The price action here is completely clinical. Capital is aggressively flowing out of high-multiple software stocks as macroeconomic liquidity tightens, and Palantir is caught right in the crosshairs. Section 2. The engine and bull case. The U.S. commercial supercycle. Look at the sheer financial leverage of Palantir's artificial intelligence platform, or AIP. Q1 2026 adjusted operating income hit $984 million. That is a massive 60% margin. They are building a highly profitable enterprise AI operating system that connects large language models directly to real-world corporate data. But here is a new data drop that completely exposes the structural divide in this business. The bull thesis lives entirely in the U.S. commercial segment, which just exploded a massive 133% year-over-year. That completely dwarfs their international government performance, which sits at 51%, and international commercial trailing at just 26%. Total divergence. What is going right? The bull case force model is driven by AIP boot camps, converting prospects into million-dollar-plus contracts at an unprecedented speed. They've secured an expanding Google Cloud distribution partnership, widening their reach significantly. Their Rule of 40 score, which is a critical Wall Street metric combining growth and profitability, is soaring to 145%. And they have guided U.S. commercial revenue to exceed $3.1 billion this year. The core equation for any upside is clinical. For this stock to work, triple-digit commercial expansion in the United States must permanently overpower the friction they're facing with government contracts abroad. It is a straight-up race between commercial adoption and sovereign regulatory pushback. If you want bull versus bear stock analysis without hype, subscribe to Future Ready. Section 3. The bear case forces, sovereign pushback, and valuation reality. Structural risks are mounting rapidly. European technological sovereignty is a direct, tangible threat to the narrative. France's DGSI intelligence agency is actively phasing out Palantir for a domestic alternative called Shap's Vision to prevent strategic dependency. Over in the UK, a massive £330 million NHS contract is facing a potential 2027 break clause due to intense political scrutiny. And Germany is imposing military restrictions specifically favoring their own technological sovereignty. The international growth story is fracturing in real time. This brings in high-profile market skepticism. Investors like Michael Burry are highlighting deep technical weakness, pointing to a death cross formation on the chart. Fundamentally, Burry warns that Palantir's forward-deployed engineer model resembles a bespoke consulting service rather than a purely scalable software company. That puts them at a major disadvantage against giants like Microsoft Fabric and Databricks. Think about this like a smart 10-year-old who understands money. If you pay $80 for a lemonade stand that only sells $1 of lemonade a year, that stand needs to grow massively just to become a normal, fair value investment. The mathematical reality here is brutal. At 80 times sales and 215 times earnings, Palantir must roughly quintuple its revenue just to align with normal software industry valuations. Section 4. Smart money and catalysts. The widest analyst spread on Wall Street. This fundamental disagreement has polarized institutional smart money like never before in the large-cap software space. We are looking at the widest analyst spread on Wall Street. Morgan Stanley sits at a $382 bull case, entirely convinced of Palantir's AI platform dominance. On the exact opposite side, RBC Capital models a $40 underperform, and Jefferies holds a $70 sell rating, arguing the valuation is totally disconnected from reality. Inside the tape, there's a massive contradiction in positioning. Corporate executives have liquidated over $133 million in stock in just the last 3 months. Yet simultaneously, funds like ARK Invest are aggressively accumulating shares. They're buying the dip on the absolute belief that this is a generational AI monopoly. The immediate catalysts that will break this tension are clear. Palantir must sustain over 100% U.S. commercial growth. If that slips to 70 or 80%, the multiple will compress violently. The market is aggressively watching the conversion velocity of those U.S. commercial deals, evolving regulatory AI frameworks under the new U.S. administration, and shifting U.S. Treasury yields, which are pressuring the entire software sector. If you want bull versus bear stock analysis without hype, subscribe to Future Ready. Section 5, the swing trader frame, momentum decay, and key support zones. For swing traders, the momentum condition has officially deteriorated into risk territory. Technical momentum decay maps a highly volatile trajectory, tracking a massive breakdown from the $160 level. This maps the complete loss of aggressive buying pressure as the stock fell below its 200-day moving average. The stock is now trapped in a $110 to $160 volatility band. The critical risk zone centers entirely on the $100 psychological support level. That exact zone dictates the immediate entry and exit logic for short-term capital trying to navigate this massive valuation reset. Section 6, Structural Long-Term Thesis, AI Operating System versus Gravity. Stepping back, the long-term structural thesis is a violent collision between unstoppable operational momentum and mathematical gravity. Palantir's survival as the dominant enterprise AI operating system is clashing directly against heavy friction. The moat is their unrivaled data integration platform, taking over the U.S. enterprise market. The friction is European protectionism blocking international growth, paired directly with that unforgiving 80 times sales multiple. The unresolved tension for the market is this. Will Palantir's U.S. commercial supercycle completely overpower these international headwinds and justify its massive premium? Or will mathematical gravity inevitably pull it down to software industry norms? This is the core debate happening across institutional desks right now. If you want bull versus bear stock analysis without hype, subscribe to Future Ready. Ultimately, the market is asking one simple question right now. Are you buying the inevitable future of enterprise AI, or are you just paying for the most expensive lemonade stand in history?